the meeting of the Finance Committee, Radnor Township School District Finance Committee, for Tuesday, August 15th, 2017. Introduction, administrative remarks. Michelle, did you have anything you wanted to cover?
I do. Actually, I think I can wait and cover it
As we go through the presentation? Perfect, thanks. Okay, then let's just move immediately to public comment. Any Finance Committee public comment?
Judy Sherry, Governor's Circle,
Hello,
Town
Judy.
Square. I mentioned the website issues at the last meeting, just would like to have more direct access to the material so that it doesn't involve a lot of clicking. The Citizens Advisory Committee, I'll again say, should be advertised and open to the public and hopefully televised, because I'm sure that they are doing some great work, and I'm excited about having a committee like this. So I'd like to have better opportunity for people in the community to see how the committee's working. My third issue falls in this committee because there's only 4 today, so is regarding right-to-know requests, because if you go to get to do a right-to-know request, you go through the business administration. I think that's where it falls. Here comes a number of questions. What's the process that takes place when a right to know is submitted? Does the district make every good faith effort to honor the request expeditiously, or does it deliberately wait till the last possible hour on the last possible day required by law? And finally, is the right to know routinely sent to the solicitor? Is that pretty much the way it happens? So there are a lot of right to know questions there.
Okay, we'll see if we
And,
can answer some of them.
Do you want to wait till I have one more?
Oh, no, keep going. We'll see.
One more. There was an article in Monday's Philadelphia Inquirer titled "Myth of the Underpaid Teacher." If there aren't any teachers in the room. The article states, of course, this is just perspective of the 2 people writing this, that the pension, well, may be accurate, hopefully, states that the pension fund is underfunded by $43 billion for teachers. But it also states that the median salary for the 100,000 or so full-time teachers in Pennsylvania is about $63,000. And when I read that, I thought, and I wondered, what is the median salary for Radnor full-time teachers? Does anybody know that, what the median salary is?
Not off the top of my head, but I'm sure we could figure that out.
I would be just interested in that, how that compares with the average in the state. Thank you. That's it.
You said the state was 63,000?
That's what this article claims, anyway.
You won't appreciate my sense of humor, but you could do a right-to-know request.
I appreciated it, though. That was kind of funny. And maybe after we answer some of her questions, she would feel better about it. Okay.
You weren't here. Yeah. I wanted you to know about the sports concussion event, which I shared with the other. Did you get
Okay. No. Thanks.
It's in off of
I think it's
Okay.
a time when I'm not going to be here.
Okay.
Yeah.
No.
Hello, Cindy.
Good evening, Cindy Spurtle, 106 Valley Forge Terrace. Since I didn't get to ask it at the end of the last meeting, because we went too long, I just would like to, I'm curious because the board meeting was posted in this week's Suburban, dated August 22nd. It has now been changed to August 29th, and I guess the one question I had is there a list of who's notified when meetings or dates are changed? Does it go to the paper first, number one? Because there are a lot of people that don't go to the home page of Radnor High School to see that dates they may have recorded earlier on.
All right, so I'm clarify for me what you're asking. You're asking when we change the date
When you change the
of a
date,
public meeting,
is there somewhere posted when dates are changed that so-and-so gets notified first, let's say the paper?
Oh.
Or a little asterisk goes on the home page,
okay.
board
All
meeting
right, well,
dates,
maybe
that
we
type
can
of
talk
thing.
about that as well. Okay.
And then the other, which I didn't get to ask in the last meeting, but also has to do with finance, is in going through the breakdown of the elementary school projected class sizes. The largest class sizes, except for Radnor Elementary, which was discussed earlier, because it's bursting at the seams, where Ithan and Wayne Elementary have had new classrooms added, and still there's a grade 5 in Ithan and 4 in Wes that are bursting. And with the new classrooms, I would have hoped that there would have been planning as the number of classrooms needed to be added, et cetera. I know part of it had to do with kindergarten.
Yeah, the limitations at Ithan and Wayne are not related to class space availability. It's based on our enrollment.
The new enrollment,
Plan.
which wasn't planned on.
No.
Oh, the new enrollment plan?
No, it's our enrollment guidelines that we follow that determines how many classes there are in each section.
Then,
It's not, in those two buildings, it's not limited by the number of classrooms,
Okay.
to my knowledge.
Well, there's like 2 extra. All right. Now, going to tonight's agenda, thank you very much. On the updates on substitutes, there was an evaluation, results of the evaluation that was being done on the substitutes. I noticed there were no attachments, graphs in tonight's attachments. And how about the cost of and the fill rate, how has that differed from prior to our contracting with Source for teachers, if there is any difference? And the couple questions, once again, on the completion of the building campaign. Are the additions and changes totally completed at Wes and Ithan? And I believe at the end of last year, there were still a few things that needed to be done. And also, is the project finished for the new playground, and is the new equipment out at Ithan? Thank you.
I'm not sure if we're positioned to answer all of those questions, but we should be able to answer the financial one. I don't know, Michelle, maybe do you want to, let's just jump into the agenda items as we have them, and then we'll hold the very end to answer some of the questions that came up if we can.
That's
Is that
fine.
right?
That's fine with me.
Okay.
So we'd like to welcome Zach Williard, Mike Lillies, and Dan O'Brien up to the table. They're going to talk to us a little bit about a possible refunding of the district's variable note. You do have a handout. There are some also on the table. There are some that are yellow and some that are white, but they are the same regardless of color.
Okay, so before we start talking, just a reminder, anybody have any problems with the minutes from last meeting? I didn't. We did. Okay, very good. Okay, hello. Welcome.
Great. Hi. Hello.
Nice to meet you.
Yeah, so we have some good news in here. We got really great proposals back. You have a bunch of different options to look at.
Okay.
So we're going to walk through that. It's a lot of stuff in here. We're going to probably limit it to pages 1 through 5, and then if there's questions, we can, kind of go on to the rest. But just for everyone's edification, from time to time, the district asks us to give them updates on your variable rate debt that you have, okay, your 2000 note. So that's what we were here for. About 2 months ago, we were tasked with going out, talking to some local banks, talking to Del Val, who your current note is with, and then also looking at the bond market to see what kind of rates you could get. The purpose would be to then issue fixed rate debt to take out your existing variable rate debt. The whole point is to limit future interest rate risk.
Yep.
Okay, so that was the task. So here's the report. If you look at page 1 in the bottom right hand corner, bottom line is fixed rates are still very, very low, historically low. That's good. Okay. Page 2. We're not going to walk through all this, kind of some of this is all recap. At the very bottom, we talk about what we did. Okay, so we're going to show you a summary page that has actual numbers to spell out, how this might look if you were going to move forward with something should you choose to. Now, we got really good proposals. The interest rates are all fixed. They're right around 2%, kind of give or take, and we'll show you all that. And I wanted to point out and kind of make you remember, you all have a AA1 credit rating, which is very, very strong for PA school districts and just in PA in general, okay? So that's what helps to drive, these good results that we have, coupled with the low fixed rate market right now. So again, it all worked out well, and I think you all should get a pat on the back just because you have such a nice credit rating. And fixing out your debt would also potentially be a credit positive with the rating agencies going forward, because typically they favor traditional plain vanilla fixed rate debt portfolios. So we'll show you the fixed rate bonds under item B there, the bank loan. RBC sent out a request for indications, and we got 4 proposals back. Okay, and we're going to show you the best ones out of those. And then we also talked to, as we said, the Delaware Valley Regional Financing Authority. They do have the ability to fix out the debt that you have now that is variable. They can switch it into fixed rate mode, okay, through a use of an interest rate swap. Okay, so that proposal is also in here.
Okay.
Page 3, just real quick, Mike, I don't know if you want to hit this chart, but again, you did great for many years, and now we're just talking about limiting future interest rate risk.
Yeah. And maybe the only other thing, that's the one key point, and the other is that that we wanted you to see how the Fed funds rate, which is in the red, has tracked with your variable rate. You can see they move pretty much in tandem, and as we mentioned last time, one of the reasons we're coming to talk to you is that the Fed has made no secret about their desire to raise rates going forward, and if that happens, your Delval rate's going to likely do the very same thing. So,
and if you kind of look where it says 2% on the far left-hand side of that graph, and scroll over, I think what's making this kind of the perfect storm is that your variable rate note is just about where you can get a fixed rate at this point. So they're converging. So that's what's creating potentially the right time to go out and do this, right? So that's why we're here. The next page, your debt summary. The point here, your 2000 notes highlighted in yellow there in columns 2 and 15. They're prepayable at any time, so you can go out and fix these out through the use of one of these options that we're going to show you here coming up. And the final maturity is 2029, so we're going to keep the same final maturity. It has about 12 years left. So there is still a good amount of time to limit that interest rate risk through the next 12 years. And then I think page 5, this is the kicker page. Okay, so we'll focus on this. So we have 5.
So good about not reading ahead.
So we have 5 options on here. I think before we really go into them, option 3 and option 5, we wanted to show them to you because they're good options. The one thing that we don't like about those options is option 3 has a prepayment penalty, which can be an issue. We typically don't want to have that. And option 5 is non-callable for 12 years, which we also don't particularly like. So while they're on here, I think we're going to focus more on options 1, 2, and 4. Okay. So first, let's go to column 7 down there, kind of in the black. If you remember, you're paying about a 150-ish right now. Okay, that rate went up when the Fed raised rates back in June. If the Fed was to raise rates tomorrow, that rate would go up again. Okay, so in column 7, what we're assuming is that you're at a 150 right now, which you are. If you look in the footnote, we assume that the Fed raises rates about 50 basis points or 0.5% next year, so it goes up because we have to make some sort of an assumption for the variable rate.
Right.
And then you can kind of walk through that, and it levels out at a 275 for the next 12 years. So depending on your view of interest rates, if you think rates might go higher than that, fine, or lower than that, but for the assumptions that we have in column 7, okay, we're assuming it levels out at a 275 for the next 12 years, which may be a little low, but we thought it was just good for illustrative purposes. Okay, so in each one of these scenarios, we're kind of comparing it back to column 7, right? So in option 1, this assumes a bond issue. Now, in each one of these options, we went through a number of different scenarios, which is what's in all the backup, and we kind of picked the best one. So the best bond issue scenario was if we did a 2-step plan, kind of like what we did back in 14 and 15, where we break them into pieces so that you can get bank-qualified interest rates and bank-qualified call features, okay? So it's a 2-step plan. Again, we're going to refinance and fix out the full $14.5 million that's left remaining outstanding. And in column 8, if you kind of combine the two steps together, this is what the debt service would look like, which is about $218,000 lower than what would happen if your Del Val stayed at a 275 for the life. Okay?
Okay.
Now, again, I don't want to get too fixated on the savings amount because this is different than what we did a couple years ago where we were refinancing fixed rate debt with fixed rate debt. Here we're refinancing variable rate debt, and we have to make some assumption.
Got it.
Right? So that's the bond issue option, okay? Now, the one thing with the bond issue option is if you were to tell us tonight that you love that option, go do that, everybody. There's still interest rate risk between now and the day we actually lock in rates, which would be at least 6 to 8 weeks from now.
Okay.
Okay, so you have rate risk there. Option 2 is the bank loan option. Now, this one came from TD Bank, right, Mike?
Yep.
Again, we picked the two-step plan that seemed to work better than if we did it all at once. TD Bank liked the bank qualified status of the loan. It's prepayable at any time without penalty, which is a nice feature. So you can pay this down. You know, if you decide 6 months from now you just want to pay it all off, you can do that without any penalty. Okay. And then in column 9, that shows you again what the debt service would be. So I mean, it is fairly similar. The interest rate that they were offering was a 2.11% fixed. Okay, and then the second step, because it was going to be a shorter piece, is going to be a 177 fixed, so it's a lower rate because it's a shorter amortization. Okay. Now the nice thing about this proposal is the interest rate risk is slightly less. Okay, this was not a firm quote; it was an indicative rate. But you know, if you decided you wanted to do something, we can go back to them, have them get credit approval, and at that point the rate would be locked
in
sooner.
with a faster close.
Correct.
Okay.
You know, one other quick thing I was going to mention that you may have noticed that if you look at the rates for the bank loan versus the bond issue, you'd say, wow, they're actually higher in both cases. How come this is a better deal? Well, the big advantage of a bank loan is there's like half the issuance cost compared to a bond issue.
Right.
That's the reason right
Yeah,
there.
that's a good point. Yeah.
The principal estimated principal is different in all of these. Do you want to review?
Well, some of that has to do with when we're assuming settlement and what the issuance costs are.
Oh, I see.
Yeah.
Okay.
And kind of how all that works.
Done.
But the net focus is the bottom half where it shows you what the debt service is. That takes into account everything
Okay.
that's included. And then if we want to skip to option 4, okay, so this is the version where we go back to the Delaware Valley Regional Financing Authority. We ask them to give us a fixed rate. Their rate was a 2.175%. You can see in the top box. Okay, so we can have that for the remaining life of the loan. We did ask them to put a 5-year call feature on it. Okay, you have to pay a premium for that. That's why the interest rate is higher in option 4 than it was in option 5. So in order to have that 5-year call, you're going to pay a premium, and then the resulting debt service in column 11 down below. Now, the one thing that makes Del Val slightly different than the rest of these options is, again, you're going to be party to an interest rate swap, a few interest rate swaps, I think, at the pool level. They're not on the district, but you are party to them, and should there ever be a termination payment in the future, the district would likely have to pay that. So I just want to point that out. But so I think those are the main 3 options. We wanted to go through them quick. I know you have a lot on your agenda. So what questions
So
can we
wait,
ask?
so 1, 2, and 4.
So why would we do 4? Just asking.
I don't know.
Okay.
That's a good question.
All right. Well, there we go. All right. We're moving in the right direction. Okay.
Because with that one, you still have the same type of interest rate risk where we would have to, that rate is an indication rate, and based on pricing in the future would be when you'd actually lock in the rate. So again, you do have the fluctuation of whatever the market does between then and now.
I think I don't know. As far as I'm concerned, we can rule 4 out.
And in
Let's
our
look at
in
1
our
and 2.
case, so the issuance cost, I'm interested to understand what that is,
Yeah.
right? Because I know that's all built in and all
Right.
of that stuff.
So I think in the bond issue, we assumed about $150,000 of costs, approximately, and then the bank loan is about half of that. That's typical. Now, we didn't go around and get quotes yet on everybody.
Right, but
should
that's
be
the ballpark you
that
work
should be a
with.
ballpark number to use. So again, I mean, these rates were very low. I mean, to get a bank loan quote for 12 years at about 2%, prepayable at any time. That's pretty good.
Hungry.
Yeah.
Yeah. In one aspect, of, like if you're looking at the bond issue versus bank loan, if one possible way to look at this is that if the bond issue were, let's say the savings were the same or they're a little bit higher, you'd have to maybe say to yourself, we would want them maybe to be maybe a fair amount higher because we're taking more interest rate risk. We have to wait longer to lock in a rate. So to make it worth our while, be nice to have maybe more savings. I don't know.
Yeah, the delta here between option 1 and 2, again, in the hypothetical savings is, I think Mike's saying it's fairly minimal. I mean,
Right.
that could be one day in the market, could be 30,000. If it was 200,000 to 600,000, maybe then, it would be worth kind of taking a little more of the interest rate risk on.
Risk. Another thing we were talking about amongst ourselves was, and I think we were talking with Michelle and Penny the other, I guess a couple days ago, was that, you look at step one for, let's say, look at the bank loan. The bulk of your savings are state one fact. You actually lose money on the second one. So one question is, do you do both of them? Now, if this were like a regular fixed rate financing like Zach had mentioned you had done in 2014 and 2015, you probably would say, I don't know if we really want to do that.
Right, we just skipped step 2.
Yeah, in this case, as Zach had mentioned, we're making an assumption of where the rates are. So it could be that this might still be worth considering if you're concerned about rates going even higher. Because then the savings would be a lot greater. In fact, I don't know, we actually took a look at a higher rate scenario just to give you a feel for what that kind of, additional savings could be if rates went higher in Del Valle.
Yeah, it was if rates went to about 1%, all these savings numbers would go up about $500,000 was the sensitivity of it.
Would you use as a discount rate?
Discount.
But in each one, it's discounted at the arbitrage yield or the
Okay.
yield of the bond.
Okay.
So each one has a different one. That's typically the industry standard for the present value.
And you'll also see if you looked at the total savings down below in like columns 8 and 9, comparing the callable bond issue and bank loan, that the savings will be a little greater on a total cash basis compared to the present value figures you saw up ahead.
Right.
It's not a big number, but since you had mentioned the discount factor, just want to make you aware there was a little bit of difference there.
So the real question is crystal ball. We're at 1.5% now. If we were to go with option 2 and lock in with a fixed loan, 2.11. The question is, how long does it take to get there? If it's more than a year, just trying to figure out what
the one part that makes it even more complicated is if we needed that is we're kind of talking about 2 different rates. So we're talking about the short-term overnight Janet Yellen, when she's on and speaks rate is what's going to help track the Del Valle, right? And then we're talking about a longer-term 12-year fixed rate, which is, in theory, they're totally different rates. And that's why when we look back at that chart, and when I think I said the perfect storm or the stars, you kind of have this nice point here where they're converging. They don't always converge. So in theory, you could try to, if you tried to time, say the short-term rate, right? So we wait, we don't do this now. We kind of put the brakes on, and then we come back once the Fed gets to 2%. Well, at that time, the 10-year or the 12-year long-term fixed rates could be 5. They could
Right.
be 4. They could
No,
be
no,
lower.
right.
So that part makes it even.
Just don't know.
yeah, they're not
harder
fixed
to-
to each other, so
Yeah.
it's a crapshoot.
So again, that's kind of why we just wanted to make sure you knew this was coming now, because this is about as close as the 2 have ever been as far as the rates go.
So the incremental cost, if we do this now, because this would happen in our 2017-18 year budget, and it would have an incremental cost, because we're paying 1.5% now, and we'd be locking in at 2 point whatever.
And Zach and I and Michael talked about this a little bit last week, that depending on how it was structured, you could push all of the savings into one fiscal year if you wanted to do that, or you could spread it over multiple. So that's how you would adjust for that.
Okay,
So we could structure the new loan, let's just say it's gonna hurt, if we do this, I'm kind of making up the numbers, but it's gonna hurt your budget by $25,000 this year, if you did option 2 today. We can structure the new transaction so that we keep in line with what you have budgeted, if that makes sense, so we can not have a negative impact to the upcoming budget, if that's helpful. I think that maybe
Yeah,
that's what you're
that's what I was
asking.
asking.
Good point, yeah.
so you can structure it that way.
Yeah.
Michelle, I forget, where are you budgeting for this, for the variable rate this year? Do you recall?
2.25%.
Okay.
So you're above.
Yeah.
So you actually would be above this anyway.
They might actually have a savings.
Yes,
Yeah.
you probably would have this.
Might.
Because we don't have this at your budgeted rate, we have this at
Right.
your,
Yeah.
the 150 and then a step up.
Okay,
So this is what we got. I mean, I think it was all good news. Now, if you want to move forward with something, you can let us know and we can work to, whether it's the bond issue or the bank loan, go back to the bank or start the process of putting together all the documents. If you remember, there's a lot of stuff, regardless of which option you pick, that we have to put together ahead of time. And then target one of your upcoming board meetings. And then bond council would come back and we go through the,
why is the estimated principal $200,000 higher in option
which
1 to option 2?
That's the same question I had asked earlier.
Oh, that was a
It's
discount
about the-
rate that you were asking.
No, about the fee, about the front-end fees
Timing.
bundled in. That's what they said.
Okay, but.
Didn't you,
That's
wasn't,
Yeah.
wasn't that about the front-end fees?
well, yeah, it typically is, although 200,000 does sound funny to me.
Yeah,
Yeah, I'm wondering if it's, does that have anything to do with the prepayment? The prepayment requirement? I'm trying to
What's
think.
that?
Fat finger.
Yeah, fat finger?
Happens from time to time. We'll have to get back to you on that one. I don't know the answer off the top of my head.
Invested again.
so you guys have, so Mike and Susan, do you have,
Go ahead.
Yeah, Dan,
Sorry.
just tell them that.
Sure, it's because the bond issue's factoring in that the bonds will be sold with what's called an original issue premium,
right?
where we're assuming that the investors basically would pay more than 100 cents on a dollar for your bonds, and that's just the structure of investor demand. And when that
Okay.
happens, it ends up reducing the amount of bonds that you actually have to issue. And that's the reason that the bond issue principal amount is lower than in a bank loan, because in a bank loan, you don't have that as part of the bank community's not, they have no demand for a premium, they want their loans to be at par.
Okay,
Yep.
got it. Okay,
But the fundamental difference between 1 and 2 is really about the bank fees are lower, even though the
Yeah,
rate is higher.
So regardless of premium and discount and the net numbers is what we always show you. That's, you want to compare 8 and 9, columns 8 and 9. Those would be the net, because the debt service takes into account everything that Dan just talked about, and it takes into account the higher issuance costs on the bond issue versus the lower on the bank loan. So that's why we were focused on the lower columns.
Yeah, and it's just eyeballing it. You kind of have a swing in the middle years where the bank loan is less under your model, and then it gets I guess it's less to the end.
Yeah, and we can work with Michelle on that.
yeah.
Some of that has to do with how, if you remember, when we look at a bond issue or whatever it is, a debt instrument for the district, it goes into the puzzle of all of your debt. And at the end of the day, we want your budgeted payment to be level or declining.
Right.
So some of that might be a function of your existing debt and how this piece kind of fits into the puzzle.
Yeah.
So, yeah, we can
well, we want the
adjust it.
payment declining, but we want to pay them off too. Like,
Yeah,
I mean,
and
you can get
you know,
declining
yeah.
payment and just push it out.
Yeah. And
you know.
I care more about the next few years.
Well,
When we're not extending the debt here.
no,
Still the same
right,
funds,
exactly,
yeah.
right. So you have any?
Yeah. The present value of the savings is worth something, I mean, right?
Should we, so I guess I'm asking, do you guys feel like we should be, given where we are in time and the convergence and all the happiness we just heard, do we think we should be?
I think we should
Moving
be.
this forward.
Yes, I do.
Yeah, I
what
don't
do
have
you-
a problem with it.
You have a problem with it, or?
Nope, I don't.
Aren't going lower.
So if it was your money, would you do option 1 or option 2?
3.
So a bond issuance or a bank loan?
Well, So again, I think the pros of option one, well, I guess the pros of option two seem like they might outweigh option one.
Okay, because it's fixed, it's known,
Less interest rate,
Short time.
less interest rate risk before we lock in the rate.
right,
It's prepayable at any time
yeah.
and
Lower costs.
lower costs.
One other quick thing we'll mention is that,
Do you both feel the same way?
you know.
Talking to me?
No, those
Pretty
two.
much, but I just want to mention one thing that Dan just reminded me in the back of in the handout behind page 5.
Yeah.
Zach had mentioned we had some extra schedules and stuff, but we had a summary of the bids we got from the bank. In fact, why don't you turn to page 7?
Oh.
And just hone in on, there's a footnote down there, footnote 1 for the TD loans, and it says, "A change in the tax status of the loan from tax exempt to taxable would result in an increase in the interest rate." That's a risk you don't have with a bond issue. And then the question is, like, how big a risk is that? And
It's really not.
it seemed like it's not that big a risk.
It's possible that the bank
Well,
may
what would
require
change
an
it?
increase in the interest rate should the district's credit
Tax
rating
exempt to taxable.
be
If they,
downgraded
I mean,
below
if
a
they really
certain level.
changed the structure of a
it
school
wouldn't have to
district
do
that
with
were
the code.
non-taxable,
It wouldn't have to do with the
It's-
tax rates
it
or
has to do
anything,
with
the
our credit rating?
IRS regulations. It would more have to do with if this financing was deemed not to meet the requirements of a tax exempt
So if you were audited
financing.
5 years from now,
and they
Yeah.
said that we weren't in compliance,
file-
now
yeah.
now we're potentially open to tax.
And you have bond counsel that's going to
Right.
give you an opinion.
All right.
That it's, so, I mean, we just wanted to disclose that. And the other thing wanted to mention is that it is possible that the bank may require an increase in the interest rate should the district's credit rating be downgraded below a certain level. However, this is subject to negotiation with the bank. When we talked to TD about this, on one hand, they said this is something that they sometimes require with borrowers from the bank, but with the district's rating at a very high level, it's the second highest rating you can get. The person we were talking with thought that might not be a requirement, and he said, depending on the district's interest in this, we could follow up with them on that.
So interesting you brought that up, because that is the one question I wrote down at the very beginning of all of this, and I'm still interested in understanding the answer. AA,
one.
1 rating.
So that's one notch below
Yeah.
AAA.
Yep, I got that. But my question is, what is it? What is the criteria that really impacts that rating, and what is the frequency at which you are reassessed and rating might be changed? Because our financial statement has changed fundamentally over the last 3 years. Our fund balance has been used up quite sufficiently, and, obviously, we've had difficult budgeting years.
The use of fund balance, they will view as a credit negative.
Use of fund balance for the purpose of operational expenses is a negative.
Correct. They would prefer that you preserve your cash and build the largest savings account you can. For example, for times when the state doesn't pass a budget and there's problems, things like that.
So Zach, when they look at fund balance, do they look at both components of fund balance, assigned and unassigned, or do they just look at the unassigned fund balance?
They look at both. Yeah.
So
If I'm-
collective fund balance. Okay,
Yeah.
what else?
And I can send you this. We didn't put it in the handout, but going back to your last rating reports that we had from a few years ago. Now they're a few years ago, but it does say strengths and challenges, and it typically lists like what could make the rating go up and what could make the rating go down. So the strengths, strong financial position, moderately sized tax base with above average wealth levels, challenges, increasing pension contributions, and then it says what could make the rating go up, sustained tax growth, improvement in financial position, what could make the rating go down, reversal of recent increases to reserve levels. So that would be an example of them citing that spending the fund balance would be a credit negative. Again, this is not my opinion. This is straight from Moody's.
What
No,
would
and I would
trigger-
be interested to have a copy of that. Would be very.
Yeah, what would trigger a review? Is it just,
Well, a couple of years ago, the only time that the rating agencies would look at you was when you were going to do a financing. Now they're moving to, kind of post-financial collapse, even though it's been 10 years, they're moving to an annual review. So I would expect we would have that soon.
Now,
And
so another question then, are we looked at in a vacuum, or are we looked at relative to other school districts in Pennsylvania?
Or relative to other businesses.
Or relative to other businesses?
Well, mostly they're going to look at you and your budget size, and then so if you have this much debt, they're not just going to say, oh my gosh, that's a high number. It's all based on, okay, well, Radnor's budget is this size, so their fund balance should be X for a AA1 category. They have lots of different metrics they look at.
Yeah, and they'll, you mentioned something about other districts. I mean, they do look at what districts' metrics or figures are, and, whatever information they're using to for the particular, like we'll use a fund balance. In the AA1 category, often what they'll do when they sign you that loan, they'll look and see what other school districts that are rated at AA1, see what their fund balance is.
Oh, so
may not-
to do it.
Yeah, so they'll use that in their different categories, like different aspects of your economy, like what's the, income per capita, things like that. So
Okay.
they do look at other districts that
Okay.
have,
So
in
they're
that rating
comps.
category.
They're looking at comps.
Exactly,
Yeah.
yeah.
Okay.
Yeah.
We'll send you the last report.
Yeah, that would be very
'Cause you-
interesting.
yeah, you haven't seen it since
actually, because it is
2015.
something that we have talked about with great frequency over the last couple of years.
Yeah, no, that's a good question.
Yeah.
And greater or lesser
In fact, I think it was
receptivity.
Understanding of it?
It was about a couple of years ago or so that when Moody's came out with they actually prepared a report so people could see what sort of calculations go into their rating. Also saying, though, that this isn't the only thing they look at, but this is something that's sort of the foundation. And to illustrate the process, they actually used the district's upgrade as a model in the report.
Oh, interesting.
Yeah, and it actually listed in detail, why they upgraded you compared to, against other districts.
I have a copy of that report if anybody's interested in it.
That would be interesting.
We showed that. We were the example they showed.
Yeah.
So net overall, I'm just making sure I'm reading this correctly. So net overall, we make the adjustment. Let's say we go with option 2 for the positive things that it brings. We're really talking with under the assumption, understanding fully, you guys don't have a crystal ball on what flexible rate changes are going to be, but based on past history with your 1.5 to 275, we're looking at roughly a $300,000 or $275,000 savings over a 14-year period of time.
Yeah, assuming column
Roughly.
7 and column 9.
Ballpark.
Yeah.
Okay.
Can I ask, just,
After all expenses,
Correct,
Yeah.
these are net.
this is
of-
net numbers,
It's also net of state aid.
Yeah.
That's also included in this.
net of state aid.
when you referred us to page 7, looking up here, we had TD Alternative 1, which is obviously the one you modeled. What's the difference between TD Alternative 1 and TD Alternative 2?
And three.
Two has the prepayment penalty included. So they offer you a lower rate. In exchange for the lower rate that you get, they have prepayment penalty.
And that sort of equates to option 2 and 3 on page 5. I think option 2 was,
Prepayment penalty.
Right,
Yeah,
so you
but
can see
not callable.
the rates
Yeah.
are lower, so there's a little more juice to the numbers, but in lieu of the lower rate, you have the prepayment penalty.
Though I can't help but wonder,
Would we really?
Would
what
we
would
ever-
cause
what
us to
opportunity
repay
would
other
we-
than doing one of these?
Well,
Yeah.
it's not, don't always think refinancing when we think about the prepayment. Kind of the risk that Mike was talking about, if this was ever, if you ever got downgraded below if they come back with a threshold, you'd want the ability to get out of this loan.
I see.
Or if the tax, something
changes.
we want to be able to get out of it.
Okay,
So that's why we like to preserve. It's not always about can you get a lower rate in the future. It's also about if you ever just need to get out of it, or if you just want to pay it down in the future, you have the ability to do that too.
okay.
Well,
Usually, what's
we
the standard?
we don't know yet on that one. I don't think.
what, on option 3?
Yeah.
It's basically a make whole call. Basically, if you tried to refinance, you're going to have to end up owing the bank what you
Whatever
originally
they would
agreed to
have
pay
made
them.
from the,
So
yeah.
you're not going to,
So-
you wouldn't save anything.
So we wouldn't save anything, but if we didn't refinance it, we'd be ahead.
Right. Yeah, I think that's.
Yeah.
That's
Is that a fair statement?
Yeah,
It's
so
a fair statement.
So if you look at option 3,
think if they're
compare
making
the
them whole, you're
compare the
making them
two
whole.
interest rate. So step 1 on option 2 is a 2.11. If you look in option 3 in the green, step 1 is a 197. So you're going to get what's that? 14 basis points lower in interest rate.
Right.
And the
Yeah.
cost, that's kind of the cost to have the prepayable at any time in option 2.
So
So,
it's $80,000 between option 2 and option 3.
yeah, but if you never go back and refinance,
It's $80,000.
It's $80,000.
I hear you.
So I just put that out there as
I hear you.
we're no worse off, and we could be better off.
So what would we like to propose? I mean, what I'm hearing is we're suggesting, hey, a $275,000 or, something north of $200,000 savings over a 14-year period of time is something that we should contemplate. What do we want to tell these guys to do?
Excuse me, I just want to mention one other thing. I thought of if you have a bank loan that's prepayable at any time, you're kind of one other benefit of this is that you could partially pay it down. I mean, I don't know if we made that clear or not. Instead of like wanting to pay it all off for nothing, you could pay off. If you had extra cash, you could pay off $1 million and reduce your debt service cost without any penalty, which you can do now with a variable rate. I mean, it's actually kind of a nice feature when
Right.
you have a
What are
fixed
the
rate.
odds of that?
At the
What
rate
are
we're
the
going?
odds of that? I'm just.
We did do some of that, though, not in that same fashion, but when we did our bond refundings, we paid off portions of bonds, and then when we did the next refunding, we paid off the remainder with the new bond issue. So you can do something like that as well if you have the prepayment option.
Okay. All right, well, so bond or bank?
I think we're looking at bank.
Okay. So do you want to go back and,
I think you work up numbers for 2 and 3 would be my.
for 2 and 3?
I would, yeah,
Okay.
because, I mean, what's our total debt position here? It's
About 90.
at a 90 some odd million. If we went with option 3, we recognize the savings. We just don't make that one that we'd go back to. And plus, this thing is over with in
14 years.
14 years, right? So we've got stuff that goes way longer than that, right?
A few years. This is one of your longer pieces. I think your debt goes out to 2035. This one goes to 2029. So
Yeah.
it's not your longest. Yeah.
No, and it would be second shortest if I'm looking at this correctly.
So if you guys want to explore 2 and 3 a little bit more in greater detail, and then we'll bring you back for the next meeting and see if we can't provide some direction.
Okay. I think we would expect at the moment, if we were to go back to them for credit approval process, for the rate to come in approximately here.
Yeah.
If that's what you like. I guess the question is, once we ask them for approval and they come back and say, here's our rate or here's our new rate or whatever, at that point a timer starts when they're only going to hold that rate for so long.
Got
Okay.
it.
So we would probably.
And how long is that?
Well, we're going to
30 days, 60 days?
30 to 45 typically,
Okay.
the most, so.
So if you wanted us to do that, I guess the question is if option 2 or 3 or whichever one, if you wanted to move forward with that, assuming that the rate was final, we'd probably want to time that so that it would make sense with one of your upcoming board meetings. Does that make
Agreed.
sense?
Yeah.
Right, well,
So we don't kind of waste our.
September.
Oh, no, agreed.
It
So,
would be the September board meeting.
It'd have to be.
Because we
Yeah.
can't do it in a week
No.
or 2 weeks.
Because bond council would have a lot of things they need to do.
Yeah.
So if you wanted us to time it with your September 26th meeting, so at that point, we would come back along with bond council. Bond council would have the formal debt resolution, which
Okay.
would lock in,
right,
whichever.
okay.
Does that
All
make
right.
sense?
Yeah.
Yep. So come back to this committee with more detail around option 2 or 3. We'll move that forward for the
September
September
board
board meeting.
Yep.
When's the,
Finance committee meeting in September.
Next
It's
one?
September,
I don't know, a month
on
from
my
now?
calendar.
Is it on the,
I can email it to you,
okay,
Zach.
yeah.
Does it make sense to lump any of these others in?
It does not. That's kind of one of our things that we're always doing is
Yeah.
paying attention A
19?
lot of those you can't refinance yet because they have call dates and we have to be within 90 days. Because we did that big refinancing plan back in 14 and 15, we kind of did a lot of it. You do have a call date coming up at the beginning of 2018, but again, there's not a lot of savings associated with that one at the moment.
Okay. So you'll get us a copy of the Moody's report
Yeah.
so we can understand that a little bit better.
Yep.
And are we good then? We good?
Yep.
We're good?
Sounds good.
Everybody's good. All right, thank you.
Thanks.
Thanks a lot.
Thank you.
Oh, my God.
What's that?
Mike is playing ping pong over here.
Oh. Rates are low.
All right, thank you.
All right, thanks, you
Thanks.
guys.
Thank you.
All right, next topic, renewal of
gosh.
auditor.
The next topic on our agenda is the renewal of our auditors. There was a copy of a proposal from
BD, BBB.
BD, where they are suggesting that their contract be renewed for 16-17 through 18-19. You can see from the slide that they did not increase their prices substantially. And from what we paid them in 15-16, we paid them $21,300, so they're only suggesting a $500 increase in the cost of the audit price. We've been quite happy with their services in the past, and my recommendation is that we put this on the board agenda for approval.
I got no problem with them.
Okay?
Good to me.
I'm okay with that. I get a little unnervy about a guaranteed $500 increase on a $22,000 bill, but whatever.
What?
Just it becomes a standard.
Well, you're saying it's, what was it in 15, 16?
$21,300.
So it's 500, 500,
300.
Yeah.
okay.
Okay, so I will put that on the August board agenda for approval. The Citizens Advisory Committee is the next topic. I just wanted to let everyone here at the Finance Committee know that the Citizens Advisory Committee's next meeting is scheduled for Monday, the 21st of August. It's at 4:30 in this building. All of the CAC members have been notified. They're anxious to get started again on some projects. So we'll be talking about the potential projects that we previously discussed and the order of what we're going to be doing. We'll also have Byron McCook and Dr. McQuiggan present at the meeting. They will be giving an overview of the technology study that's been ongoing by the district. That was a recommendation from the CAC with looking at iPads. So they'll be giving an update on that, and I'm sure that the committee's looking forward to receiving that update.
Okay, yes. Okay.
Okay. The next item, the update on the collection of 2017-18 real estate taxes. August 31st is the end of the discount period, so we've seen a fairly large increase in tax payments coming into the district. Mortgage companies typically this week and next week will be making very large deposits on behalf of many of homeowners in Radnor. So
I made a very large deposit this week.
I'm holding out to the very last minute.
I'm leaving on
Damn it.
vacation. I had to make a very large deposit this
So
week.
next month, I'll give an update on what the percentage that we collected in the discount period. We've also seen increases in people making their first installment because, of course, if you recall, if you're using installment payments, you need to do that by August 31st as well. And then the last item, Mr. Stitzel.
Before you go to the last item, just with the Citizens Advisory Committee, I know there had been a question about whether those meetings would be public, and I know there was some email discussion with the committee, but I don't know that we've really had any formal discussion with them. Has there been?
We have only had email discussion about whether or not those meetings should be public or not be public. I imagine that we'll talk about that on Monday as well.
Okay, so that's something
We
that.
can talk about
we
that
could-
back at this meeting.
I think that's fair. Before we, a committee that was created that I don't know that was discussed with the committee that they would be public meetings, before we make a decision there, I think we should at least talk to that committee and talk as a board. So I just want to, I think we should make a determination, and then we can determine whether we want them to be public or not as we move forward.
Thank you. All right, substitutes.
That was good timing. I apologize, I was at the Health Trust. I do not have a report this month for June because we were digging into this substitute and the numbers and why they were so high, and we thought we found the answer, and we were digging into it, and we started talking to building secretaries individually. We brought them into my office with my staff to try to find out what was going on. And we thought we may have found the cause, but then when we looked into it a little deeper yesterday, or Thursday, I guess it was, then it wasn't what we thought it would be, the results. And what I mean by that is we thought some of the times they were double counting, not that we were being double charged, but if Mrs. Smith was out and her replacement was in there, we thought Mrs. Smith being long-term out and the replacement was counting as two, but it wasn't. We do have some double counting, meaning that if Mrs. Smith's replacement was out for a day, that got double counted, so we were backing those out. So we'll have all those numbers backed out, and I'll give you the year in review in September, so we have that information.
So is there a discussion going on with the building principals about addressing, because even with those kinds of adjustments, there's still a significant issue?
I have talked to some building principals. I talked to some other administrators to try to find out what exactly is going on. They're going to be thinking about it, and we have a retreat for the administration on Tuesday, I believe. So I want to bring it up there that all the administrators will be in the room together, that maybe we can start bouncing ideas off of each other, what it may be, then I can come back to you in September with the results of that administrative retreat information.
And, I'm sorry, go ahead.
I was going to ask, how aggressive have we been with trying to recruit guest teachers from within Radnor Township?
We had 6 individual hiring events within the district that were located here at our administration building. Last year, there were 3 regional recruitments. We had Source for Teachers represented us at job fairs at Eastern University, Rosemont, Cabrini, Newman, Delaware County Community College, Widener, Westchester, Alvernia, Kutztown, the Greater Philadelphia Expo. We were on CareerLink. We physically attended some of those job fairs as well.
But if I'm a retiree and a retired chemist in Radnor, and I'd be interested in doing this from time to time, how would I have known that? Because that's not my typical venue.
So that's what we thought about over the summer, too. So what we want to do is Source for Teachers will be showing up at some of our back-to-school nights, some of our sporting events, to have tables out there. We've asked them for more yard signs, that we can put some more yard signs up around the district. So we kind of looked at what we did and where we can potentially go, because you brought that up before, and I've been thinking about that. How can we get to the person who may not be dropping their students off at school?
Right.
So we are going to...
Hearing this, Linda?
You will hear presence.
A newspaper article would be a great idea,
A
Todd.
newspaper article might be wonderful.
So we are going to have that bigger presence at our functions, and what I'd like to do, and I haven't really talked to Ken about this, so it's kind of going to be a surprise for him, but I'd like to kind of get some of the local clubs like Lions clubs and Rotary clubs and those type of things, that I can potentially go to some of their meetings, because a lot of times there's contacts there that will be able to push them out.
Okay.
So I think we did a good job pushing it, but we're going to push it even harder this year. We've got the first year under our belt. We kind of know where our deficiencies may be. Last year, we ultimately had 5 building subs at the secondary levels at each building. We had 3 at each elementary building. This year, we're going to start out with 4 at each of the secondaries, and 3 at Wayne and Ress, and 2 at Ithan. And the reason it's not equal with Ithan is, if you remember talking last year, Ithan's absences weren't as bad. So I don't want to bring somebody in this early in the year, pay for them if they're not doing something. So we're going to start a little lower. We're not starting them the first day. We'll be starting them the next week. So we have that, because I figured a lot of teachers aren't going to take off the first week of school. So we've got things that we've been adjusting around. We will be meeting with RTA once school gets settled in, to find out if there's anything that they would suggest as well, that maybe we can come back with those. What is it a morale issue? Is it a stress issue? Those type of things.
Yeah, I think we really need to start, at this point now, we've collected enough information, clean it up a little bit more, just make sure there's no anomalies in there, but we need to start looking for why and doing something about it. Because the problem, the fill rate, it seems like at least that's under control, but imagine how much better our fill rate could be if we didn't have as many people out. I mean, we'd be well above where we have been in the past. Two questions, no, one question. The Alumni Association. Have we done anything through the Alumni Association?
I have not, but
I mean, they've got a ton of email addresses and communication, and in fact, they'll be sending out a mailer over, because in the fall, coming back for their September, October, they'll have big fundraising event activity going on and an alumni gathering.
Okay.
Perfect time to say, hey, come back and teach.
Yeah, and
Contact.
also I would use venues like the Radnor High School Scholarship Fund, opportunities to just, make this increase the awareness that this is something people can do. Because my sense of things is, if people knew they could do it, we'd see a significant increase in applications, particularly in areas where it's harder to fill with a substitute. You got to find somebody who can teach a higher level math class or a higher level physics class. I mean, these folks are in our neighborhoods, and so anyway, yeah.
Okay.
And we also said we'd be sending out a survey to the subs to find out if there's anything the district is doing or not doing.
That is good.
We had 44 respondents out of a little over 100 subs, so I thought that was a pretty good rate. We have no major barriers. The one thing I found is some people said it's a little far to drive. We don't know where they live. They said our rate was competitive. Some people said it wouldn't hurt to earn a little more money, which that's out there. Like this one on the top, she loved working here. Unfortunately, she wasn't able to work in the month of May because she got a new puppy. So there's just different things, and we have a lot of comments that I'll be bringing again.
They're called life choices.
This again up at admin retreat, so the principals can hear this. That they can have their secretaries got some kudos in here that the subs love coming in and talking to the secretaries that were friendly, and so really in the respondents, there's nothing that is saying the school district isn't meeting their expectations or those type of things. The respondents were very positive to our district, so that's something our buildings can be very proud of. And like I said, I'll be sharing these with the administration next week that we can maybe fix some of the things of their suggestions.
Okay, great.
Awesome.
That's all I have.
Thank you. Sure. Good. So Michelle, maybe can we loop back on a couple of the questions that might have come up earlier this evening and see if we can answer any of those, or
Yes, we can.
Mr. Batchley?
We can start with the right-to-know process.
Yeah.
Currently, the district right-to-know process is right-to-knows come into the business office. Jackie, my secretary, actually keeps a log of all of the right-to-know requests. The first thing we do is we try to identify who would have the information that's being requested. So sometimes that can take us a little while to determine all of the people who need to be involved. We'll have a meeting if it involves a computer search with the technology department and determine what the criteria of our search is going to be. We do notify the solicitor with most of our right-to-know requests, not all of them. If a right-to-know request is something as simple as wanting to know about information regarding bids that were awarded or something like that, we don't identify the solicitor or notify the solicitor. But if it's a more involved right-to-know request, we will forward that on to the solicitor.
So notify them that you have it, or seek direction from them, two different things.
Notify them that we have it. We've got a standard letter that we use, our 5-day letter and our 30-day response. We've got standard letters for that, and we use those. If it's an involved request, our solicitor may suggest that we send the response back to them for review before we send it out.
Fair enough.
And we will do that. Typically, if we can answer the question within the 5-day response, we will. If it requires additional time, or it's going to require a more involved search, or it involves school board members, for example, and during the summer when people are not always in, we will ask for a 30-day extension.
Okay. All right, pretty cool. I think that maps out the questions that were asked.
And the one other question that was asked was if we always wait till the last day. Typically, in a 5-day response, it takes us all 5 days to get all the information together that we need and to determine whether or not we're going to need a 30-day extension.
Okay.
So typically, the 5-day response will go out on the 5th day. And during a summer, when we're closed on Fridays, it's 5 business days, so it's only when the district is open.
Okay.
And for anything received after 4 o'clock, that's determined to be received the next day.
Got it.
Okay? I think that answers
The
the
questions on the right to
questions on
know?
right to know.
It takes you 5 days because there's a lot of people that get requested for the information, so they have to look through all their stuff, and you guys also have day jobs, not just right-to-know stuff.
Well, typically, the biggest problem we have with the 5-day response is trying to determine who
Who
we
needs to be
all need to
involved,
be,
yeah.
who we all need to contact. We might get a request for something, and I might have to reach out to the athletic director because it involves information from coaches and things like that, and I won't always know who those people are. So it can be a pretty involved process of trying to just identify who needs to be contacted to get the information back.
Okay.
And summertime, people are not always in during the summer, and it's difficult to reach people within that 5-day period.
Okay.
I
Meeting
do-
date changes was another
Meeting-
question.
Meeting date changes. I don't know that we have a written protocol for meeting date changes. Jackie typically notifies the newspaper once it's been confirmed that the meeting date has been changed. I actually did that this week, and I didn't do a very good job at it, I must admit, or last week, because Jackie was on vacation. But I do think it would be a good idea if we did have a protocol. So we can discuss that. We have cabinet tomorrow. Maybe we can discuss it at cabinet. I have asked Michael Petiti to put something on the website, but I didn't do that until later today, this afternoon. So I'm sure he hasn't done it yet.
Okay. Teacher's salary, the median, so Todd, you weren't here, and we may not be able to speak to it now, but I would be interested. Apparently, there was some sort of a report looking at teacher salary across the state, and the median was reported to be $63,000. The interest was, what is the median in Radnor?
We can get that for you.
Yeah, I thought we could, too. Okay?
And then the construction at Ithan and Wayne.
Yep.
The construction at Ithan has been completed. That's the building construction. There is still some groundwork at Wayne that needs to be done, and there's a couple outstanding invoices on Wayne as well that need to be done. We have an outstanding insurance claim with the elevator damage that we're working on. That is still open, but that is being handled by the insurance company, and I expect that that will be finalized very shortly.
So the capital fund remainder at this point in time on the construction is what? Roughly? Ballpark?
1.3
Million?
million.
Still?
Yes.
And how
remember,
much of
we
that
had-
do we think will end up
We
really needing?
actually talked about the fact that we used that in 17, 18 to help us offset some of our costs.
Yeah, I remember, so that's why I'm interested. Okay.
In regards to the Ithan playground, they are actually having, they might have,
Open house.
they might have had it, or,
21st, I think it is.
I think it's the 21st, they're having an open house for the playground. The playground, there is a couple issues that still need to be addressed. The manufacturer was going out to look at the playground this week, just to ensure that some of the bolts that we were looking at are the correct ones. When our insurance carrier was there doing the walkthrough, he wanted the inspector to come back out and look at a couple of bolts on the playground equipment.
Okay.
The grass is starting to grow, and we've just entered into a contract with our landscaping company to help us get that grass
Stabilized.
stabilized
Okay.
and things like
All
that.
right, cool. Okay, awesome. I think that addressed all the questions that I took note on. Anybody have anything else from up here? If not, public comment? Going once. Really?
Well,
Darn,
Oh,
we're
come on.
good. No. I'm taking that as a win. Thank you all very much. Then we will. Come on, we
I was like, wait a minute.
All right. Have a good night.